Welcome to our deep dive into the world of value investing. We've got some fascinating excerpts from a book on the subject, and we're going to try to unpack its wisdom together. I'm really excited to dig into this.
Yeah, this should be fun.
It's like a crash course in becoming a smarter investor, right?
Yeah.
We'll uncover those pitfalls that trap so many,
Right.
and by the end, hopefully you'll have a solid grasp of those core principles
Yeah.
that make value investing tick.
What's often misunderstood about value investing is that it's as much about psychology as it is about numbers.
Oh, yeah.
We're not just dealing with balance sheets and income statements, right?
Yeah.
We're grappling with often irrational behavior of the market.
Absolutely. Oh, tell me about it. I've definitely made my share of impulsive investment decisions, driven by fear or greed, right?
Oh, yeah.
The book dives right into that, highlighting the dangers of letting emotions cloud our judgment. It warns against falling into those classic traps of buying high and selling low, driven by that herd mentality, rather than careful analysis.
Right. That herd mentality often leads investors to treat stocks like what the book calls trading sardines.
Okay.
They focus on the short-term price movements and speculation, rather than the underlying value of the business. There's this great anecdote in the book about a sardine craze, right? And the price of a can skyrocketed. It turns out when someone actually tried to eat them, they were rotten.
Oh, no.
Yeah, and the seller's response, these aren't eating sardines, they're trading sardines.
Oh, wow. That is fascinating. It's a perfect illustration of how speculation can completely detach from a business's real worth. The book uses historical examples to drive this point home. Remember the disk drive company bubble in the 1980s?
Absolutely. The market was valuing these companies at billions, but the fundamentals simply couldn't support those prices. It was a classic case of trading sardines. And when that bubble burst, investors learned a painful lesson.
Ouch. That's gotta hurt. Speaking of mispriced opportunities, the book introduces the concept of Mr. Market. And this is a clever analogy. That helps us understand how market swings can be irrational and emotionally driven. Tell us a bit about Mr. Market.
So Mr. Market, as the book describes, is that ever-present force in the stock market, offering to buy or sell securities at prices that don't always reflect their true value.
Okay.
He's moody, unpredictable, sometimes euphoric, sometimes depressed.
Oh, so he's like a real person. So how do we avoid being swept up in this emotional roller coaster? Should we just ignore him?
Ignoring him completely would be a mistake. He can actually be a valuable source of opportunity if we learn to recognize.
Okay.
And he's being irrational.
Okay.
The key is to view Mr. Market as a potential servant, not a master.
Okay, I like that.
He's there to provide us with potential bargains, but we shouldn't let his mood swings
Yeah.
dictate our investment decisions.
Yeah, it's about maintaining that emotional discipline and sticking to our own independent analysis of a business's worth, even when Mr. Market is having a meltdown or a manic episode, right? No. The book doesn't hold back. In its critique of Wall Street, it paints a pretty bleak picture of a system that is rigged against the average investor.
Right. Well, the book argues that Wall Street's structure often creates inherent fear of the reckoners. Conflicts of interest. What's profitable for Wall Street isn't necessarily beneficial for the individual investor. Think about those upfront fees and commissions that are the bread and butter of many Wall Street firms.
Right. It's like that old saying, if you're not paying for the product, you are the product. Is
Yeah.
the book saying individual investors are the product on Wall Street? That's a little unsettling.
Yeah, the point is that this fee structure incentivizes Wall Street to prioritize frequent transactions and the creation of complex financial products, even if those aren't in the best interest of their clients.
Oh, wow.
So instead of focusing on long-term value creation and providing sound financial advice, the system often pushes investors towards high commission securities and frequent trading.
Right. The book is an example of brokers pushing those high commission securities over simple, low-cost options like no-load mutual funds, or even treasury bills, which might be a better fit for some clients' needs.
Exactly. And think about Wall Street's preference for underwritings, where they help companies issue new securities. These transactions generate significantly higher fees for them than simply facilitating trades in the secondary market.
So in a way, Wall Street is incentivized to constantly create new products to sell, regardless of whether those products are actually beneficial for the average investor.
Right. That's the inherent tension that the book highlights. This focus on short-term gains and transaction volume trickles down to investors, fostering a culture of chasing quick profits instead of seeking long-term value.
Oh, wow, that's powerful. So it's a system that can really encourage impatience and speculation. Speaking of speculation, the book also argues that Wall Street has a built-in bullish bias.
Right, of course. A booming market benefits Wall Street. It means more transactions,
Yeah.
more underwriting deals, and generally happier clients who are less likely to question their broker's recommendations. So when Wall Street analysts are overly optimistic, it's essential to take their pronouncements with a healthy dose of skepticism.
It makes sense. Wall Street's success is often tied to a rising market, so it's in their best interest to promote that positive sentiment, even if it's not entirely warranted by the underlying economic fundamentals.
Yeah, that's why it's so important for individual investors to develop their own independent judgment.
Yeah.
Don't blindly trust the hype or rely solely on what Wall Street is selling.
Don't drink the Kool-Aid. Don't forget
No.
about those financial innovations that Wall Street loves to cook up. The book uses the example of IOs and POs, those interest-only and principal-only mortgage securities. They sound incredibly complicated.
Yeah, they were. And their complexity played a role in the 2008 financial crisis.
Oh, wow.
These products were often presented as being beneficial for investors, right? Offering diversification and hedging opportunities. But in reality, the complexity masked significant risks, particularly during times of interest rate volatility. When the housing market collapsed, the value of these securities plummeted, leading to widespread losses.
Ouch. It sounds like the lesson here is to be wary of anything. That seems too good to be true, or too complicated to understand. If you don't fully grasp the underlying risks, it's best to steer clear.
Absolutely. And that brings us to another important point, the danger of investment fads. The book used the business franchise craze of the late 1980s as an example.
Yeah.
Suddenly, every company was claiming to be a franchise, even those with little to no real competitive advantage.
Right. It's that herd mentality again. Everyone wants to jump on the latest bandwagon, even if it's headed for a cliff. How do we avoid falling for those fads?
It comes back to focusing on the fundamentals of a business. Look beyond the hype and the catchy labels. Ask yourself if the company has a durable competitive advantage, if it generates consistent cash flow, and if it's trading at a price that reflects its intrinsic value.
You know, it's striking how many of these pitfalls need to stem from a short-term mindset and a lack of focus on the underlying value of a business. Seems like a lot of investors are focused on those, trading sardines rather than the real eating sardines, right?
Exactly. That's precisely the shift in perspective that value investing aims to cultivate.
Yeah.
It encourages us to see stocks not as mere pieces of paper to be traded, but as ownership stakes in real businesses. And it emphasizes the importance of understanding those businesses, their strengths, their weaknesses, and their long-term potential.
Okay. So we've explored the pitfalls of emotional decision-making, Wall Street's inherent conflicts of interest, the allure of investment fads, and the danger of trading sardines. This all sounds pretty bleak.
Well, don't worry. It's not all doom and gloom. The good news is that there's a path to navigate these treacherous waters and become a smarter, more successful investor. That's where value investing comes in. And that's what we'll explore next.
It's interesting, you know, even those big institutional investors with their teams of analysts and mountains of data, they often fall into some of the same traps we've been discussing.
You're kidding. You'd think those institutions would be like the epitome of rational, disciplined investors. What goes wrong?
Well, for one thing, they're dealing with enormous sums of money, which creates its own set of challenges.
Oh, I can imagine.
It's not always easy to find enough good investment ideas, right?
Right.
To deploy all that capital effectively, especially when you're primarily focused on large, well-established companies.
I imagine there's only so much untapped value to
Yeah.
be found in those big-name stocks.
that everyone's already scrutinizing.
Exactly.
Yeah.
And there's this constant pressure to maintain those massive portfolios,
Mm-hmm.
which can lead to holding on to investments, even when they're no longer attractive,
Right.
or straying from a value-focused approach.
It's like they're stuck in this cycle
Uh.
of needing to stay fully invested, even when there are few compelling opportunities.
Then there's the relative performance trap. Institutions are constantly being judged against their peers and the market, which encourages them to follow the herd. Rather than seeking absolute value,
Right.
it creates this perverse incentive to mimic what everyone else is doing, even if it means making subpar investments.
So even those giant institutions can get caught up in trying to team up with the Joneses, so to speak.
Yeah, it's a real problem. And don't forget about the rigid categorization that many institutions impose on their investments. They might have separate buckets for equities, bonds, real estate, and so on, which can prevent them from exploiting those unique opportunities that blur the lines between traditional asset classes.
So a bond of a struggling company. That's trading more like a distressed equity. Off limits.
Precisely. They might miss out on those unconventional situations.
Yeah.
Because they're too focused on fitting everything into neat little boxes.
Right.
And then, of course, we've seen the rise of index funds, which have their own set of complications.
Right. Index funds. They're often touted as a simple, low-cost way to invest. What's the downside?
While index funds can be a perfectly sensible choice, for many individual investors, their growing popularity has some unintended consequences. For the market as a whole,
Oh, really?
when indexing becomes too widespread, it can actually reduce market efficiency.
How so? Aren't index funds simply tracking the market, allowing investors to ride the wave of overall economic growth?
Well, they are. But when a significant portion of the market is passively invested in index funds, fewer investors are conducting the fundamental analysis needed to identify truly undervalued companies.
Oh.
Everyone's just buying the same basket of stocks,
Yeah.
regardless of their individual merits.
It sounds like it could create a situation where stock prices become less tethered to the actual performance of the underlying businesses.
Right, that's the concern. And it could also lead to those index funds buying high and selling low, simply because they're obligated to follow the index's movements, even if those movements are driven by irrational exuberance or panic.
So even though index funds are designed to be passive, their sheer size and influence can inadvertently distort the market.
Yeah.
Fascinating.
And there's another wrinkle. Index funds, by their nature, are passive investors. They can't actively engage in shareholder activism, even though they often hold substantial stakes in companies.
So even though they could potentially wield significant influence, they're not pushing for positive changes or holding management accountable in the way that an active, engaged investor might.
Precisely. Now, shifting gears a bit, let's revisit the junk bond craze of the 1980s. The book uses this as a cautionary tale, highlighting how even seasoned investors can be seduced by the allure of high returns without fully grasping the risks involved.
You know, I've heard those stories about the junk bond kings of the 80s, but I've never fully understood what went wrong. Were junk bonds simply a bad idea from the start?
Not necessarily. Junk bonds are simply bonds issued by companies with lower credit ratings. They offer higher yields to compensate investors for taking on more risk. The problem in the 1980s was that the entire market was built on some flawed assumptions.
Such as?
The main one was that junk bonds had inherently low default rates, but this belief was based on historical data from a period of bond, relatively stable economic growth, and low interest rates. When those conditions changed, defaults surged, and investors were caught off guard.
It's like basing your investment strategy on the assumption that sunny weather will last forever. Sooner or later, a storm will hit.
Right, a great analogy. And in the case of the junk bond market, several factors contributed to the storm. We had mutual funds chasing those high yields, thrifts using junk bonds to try to boost their returns, and investors relying on potentially misleading metrics like EBITDA to assess a company's financial health.
You've mentioned EBITDA before. It's one of those acronyms that gets thrown around in the financial world, but I'm not sure I fully understand it.
Right. It stands for earnings before interest, taxes, depreciation, and amortization. It's often used as a proxy for cash flow. But it can be misleading, especially for companies with high debt levels.
How so?
Well, because EBITDA ignores the very real costs of servicing that debt. It's like boasting about your income without acknowledging your monthly mortgage payments or credit card bills.
So it can create a distorted picture of a company's true financial position.
Exactly. And then there was those complex financial instruments known as collateralized bond obligations, or CBOs. They were essentially bundles of junk bonds that were sliced and diced into different tranches, with the senior tranches receiving investment-grade ratings from the agencies.
So investors were led to believe that these CBOs were safer than they actually were.
Yeah, that was the problem. The ratings agencies were relying on historical default rates, but they failed to adequately account for the possibility of a major economic downturn or a credit crunch. When those events hit, even those supposedly safe senior tranches took a hit.
It's like building a house of cards on a shaky foundation. Sooner or later, the whole structure is going to collapse.
Right, and that's what happened in the junk bond market. It was a painful lesson for many investors.
Right.
A reminder that high returns always come with higher risks. And those risks need to be thoroughly understood and carefully assessed.
It seems like the key takeaway from these cautionary tales is that we need a more robust framework for making investment decisions, one that goes beyond chasing returns or relying on Wall Street's pronouncements.
Right. That's where value investing comes in. It's a disciplined approach that focuses on understanding the true worth of a business, identifying those hidden gems that the market has overlooked, and patiently waiting for those opportunities to materialize.
An essential tenet of value investing is acknowledging that the future is inherently unpredictable. We can't know for certain what will happen with the economy, interest rates, or even the fortunes of a specific company.
That's why value investing emphasizes building in a margin of safety. It means buying at a discount to our assessment of a business's intrinsic value, so that even if things don't go as planned, we're protected from significant losses.
That sounds like a sensible approach, but how do we actually go about valuing a business? Isn't that incredibly complex?
Oh, it can be, but the book emphasizes that. Precision doesn't guarantee accuracy.
Right.
We can run all those fancy net present value calculations and build elaborate financial models, but ultimately, they're only as good as the assumptions we feed into them.
And predicting the future, as we've seen, is a notoriously tricky business.
Right. That's why conservatism is key. We're better off making conservative assumptions about future cash flows and then demanding a substantial margin of safety to protect ourselves from unexpected events.
So it's better to err on the side of caution, especially when it comes to valuing a business.
Absolutely. And then there's the discount rate, which is often overlooked, but is crucial in determining the present value of future cash flows. The discount rate should reflect the riskiness of the investment.
So a riskier investment requires a higher discount rate, which means those future cash flows are worth less in today's dollars.
Precisely. It's like saying, I'm not going to pay as much for those potential future earnings because there's a greater chance they might not materialize.
Okay, that makes sense. But the book also talks about the limitations of using private market value as a benchmark.
Private market value is often touted as the gold standard for valuing a business, but it can be misleading, especially when it's influenced by factors like non-recourse debt or market bubbles.
Non-recourse debt, can you remind me what that is?
Sure, it's debt that's secured only by the specific asset being financed. The lender has no recourse to the borrower's other assets. It can lead to buyers overpaying for businesses because they're not personally liable for the full amount of the debt.
So it's like playing with someone else's money. It can distort those private market values and create a false sense of what a business is actually worth.
Exactly. And then there's the perennial problem of market bubbles, where prices become completely detached from reality, as we saw with the junk bond craze.
Right. So how do we avoid overpaying when those private market values are inflated or unreliable?
By considering other valuation metrics, such as liquidation value, which is essentially what you could get for a business if you sold off all its assets.
It's like a fire sale price. It provides a floor for the valuation, a worst-case scenario.
Precisely. The book also mentions the concept of net working capital, which could be a quick and dirty way to assess liquidation value. It's essentially the value of a company's current assets, minus all of its liabilities.
So if a company's stock is trading below its net working capital, it could be a potential bargain.
It's a possible signal. But you have to be careful. You need to make sure those working capital numbers are accurate.
And that the business
isn't rapidly burning through cash.
Good point. So we've got liquidation value, net working capital. What about stock market value? Isn't that the ultimate measure of a company's worth?
Not necessarily. Stock market value is just one data point. And it's often influenced by factors that have nothing to do with the underlying business.
Like those emotional swings, market fads, and short-term speculation we talked about earlier.
Exactly. The market can be irrational in the short term, and stock prices can deviate significantly from a company's intrinsic value. But over the long run, there's a tendency for stock prices to reflect the fundamentals of the business.
So stock market value can be a helpful indicator, but we shouldn't blindly accept it as the gospel truth.
And it's important to remember that the relationship between stock market value and business performance can be somewhat reflexive.
Reflexive. I'm not sure I follow.
It means that sometimes the market's perception of a company can actually influence the company's real-world performance.
So if the market believes a company is doomed, it might become a self-fulfilling prophecy.
Yeah. Exactly. A depressed stock price can make it difficult for a company to raise capital, which can further hurt its business.
It's like a vicious cycle. But the reverse can also be true, right?
Absolutely. If the market is overly optimistic about a company, it might have an easier time raising capital.
And growing its business. even if that optimism isn't entirely justified by the underlying fundamentals.
It's a reminder that markets aren't always perfectly rational, and that investor sentiment can play a powerful role in shaping outcomes.
Okay, so we've delved into the complexities of valuation, explored the pitfalls of relying on private market value, and acknowledged the reflexive nature of markets. What's next on our value investing journey?
Now, we're going to dive into the heart of the value investing process itself. Remember those three central elements we discussed earlier: bottom-up investing, absolute performance orientation, and a focus on risk aversion.
I do. It's like a mantra for value investors, but it would be great to unpack those concepts a bit further.
Absolutely.
Yeah.
So let's start with the bottom-up approach value investors typically focus on. Identifying specific undervalued opportunities, one company at a time, without getting bogged down in. Trying to predict macroeconomic trends or market-wide movements.
It's like being a detective, searching for those hidden gems in the market.
Yeah, that's a great analogy. And it frees us from having to be right about the big picture.
Yeah.
We can focus on what we can control, understanding individual businesses
Yeah.
and their fundamentals.
So instead of trying to time the market
Right.
or predict which sectors will outperform, we're looking for those companies that are out of favor, that are trading below their intrinsic value, regardless of what's happening in the broader economy.
Exactly. And because we're taking this bottom-up approach, we have a clear understanding of what we're betting on and when to sell. We're not just blindly following the herd.
It sounds like a more grounded, less speculative approach.
Right. It is. Now let's talk about absolute performance. How does that differ from relative performance? Most investors, especially those institutions we discussed earlier, are obsessed with relative performance. They want to beat the market or their peers, even if it means taking on more risk.
Right. It's that keeping up with the Joneses mentality we talked about.
Exactly. But value investors are more concerned with absolute performance. We want to achieve a positive return, regardless of what the market is doing.
So it's about growing our wealth over the long term, not just bragging about beating some arbitrary benchmark.
Precisely. And finally, the third element, risk aversion. This is crucial. For value investors, we're just as concerned with how much we can lose as with how much we can make.
Right. It's about protecting our capital, not just chasing those elusive high returns.
And that means rejecting the notion that risk is solely determined by price volatility. Remember that beta measure we talked about earlier? A stock that's bouncing all over the place might actually be less risky than a seemingly stable stock that's significantly overpriced.
Right. Because a volatile stock might be temporarily out of favor, while an overpriced stock might be headed for a much steeper fall when the market eventually corrects.
Exactly. Value investors are more concerned with the fundamental risks of the business, those factors that could permanently impair its value.
So value investing is a disciplined, patient, and risk-averse approach to building wealth. But the million-dollar question is, how do we actually find those value investment opportunities? It sounds like a needle in a haystack proposition.
It can be, but that's where the real detective work comes in. It's about thinking differently than the crowd, looking in those overlooked corners of the market where others aren't paying attention.
So where do we start our search? What are some of the hunting grounds for value investors?
The book suggests exploring areas like spinoffs, rights offerings, and companies facing temporary setbacks. These are often situations where the market isn't fully appreciating the true value of a business.
Those spin-offs sound intriguing. Can you tell me more about them?
Absolutely. Spinoffs occur when a company separates a division or subsidiary into a separate publicly traded entity.
And why are they often mispriced by the market?
There are a few reasons. Sometimes institutional investors are forced to sell those spinoffs because they're too small for their portfolios. They might have rules that prohibit them from holding companies below a certain market capitalization. There's also often a lack of analyst coverage and investor awareness, which can lead to undervaluation.
So these spinoffs are kind of flying under the radar, and value investors can potentially scoop them up at a bargain.
Yeah, that's the idea. It's like those hidden gems tucked away in a dusty corner of an antique shop. What about rights offerings? Those can be interesting as well.
You've piqued my curiosity. Tell me more.
Rights offerings give existing shareholders the right to buy new shares at a discount. And sometimes those rights are mispriced, creating an opportunity for value investors to step in.
It's like getting a special coupon to buy more of something you already like at a reduced price.
Exactly. And then there are those companies facing temporary setbacks. Maybe they've had a bad quarter or there's some industry-specific headwind, but the underlying business is still fundamentally sound.
So it's about differentiating between those transient problems and long-term potential.
Precisely. The book also emphasizes the importance of looking for catalysts, those events or developments that can unlock a company's hidden value and potentially lead to a re-rating by the market.
Catalysts like what? Give me some examples.
It could be a change in management, a new product launch, the resolution of a legal dispute, a restructuring of a business, or even a shift in industry dynamics. The key is to understand why a security is undervalued and what might change that perception.
It's almost like you're looking for those companies with a great recipe that's just sitting in a dusty old cookbook that no one's opened in years. The catalyst is what brings that recipe back into the spotlight. Now, the book shares some real-world examples of these value investment opportunities. One that caught my attention was Citi investing liquidating trust.
Ah, yes, a classic case of how complex situations can create opportunities for value investors. Citi investing was a conglomerate that decided to liquidate, but it had a bunch of diverse assets that were difficult to value, which scared off most investors.
Those who were willing to roll up their sleeves and do their homework were rewarded with a bargain.
Exactly. The trust units were trading at a significant discount to their intrinsic value, simply because of the perceived complexity and uncertainty surrounding the liquidation process.
And as the assets were sold off and the liquidation progressed, those patient investors reaped the rewards.
Precisely. The book also mentions a few other intriguing examples, like that unusual preferred stock issued by Bank of America, and those contingent value rights from Marion Laboratories. These were complex securities that most investors didn't understand, so they traded at a discount.
It seems like complexity can create opportunities for those who can decipher it. Now, what about those rights offerings we talked about earlier? The book uses a closed-end mutual fund as an example.
Yes. Sometimes shareholders in closed-end funds don't fully understand the implications of rights offerings, or fail to exercise their rights. This can create a situation where those rights become mispriced, presenting a potential opportunity for value investors to buy them at a discount.
It's like finding money on the sidewalk because someone else didn't bother to pick it up. Now, let's shift gears a bit and talk about risk arbitrage. It sounds a bit like gambling.
Well, it's not gambling, if you know what you're doing,
and
carefully manage the risks. Risk arbitrage involves investing in companies that are involved in mergers, acquisitions, or other corporate events. The goal is to profit from the difference between the current market price and the price that will be paid if the deal goes through.
So essentially, you're betting on the deal being successful, but what's the catch?
Well, the catch is that deals can and do fall apart. If that happens, you could lose money. That's why experienced risk arbitragers carefully assess the probability of the deal closing and factor that into their pricing. They're looking for situations where the potential reward outweighs the risk.
It's almost like being a professional poker player. You have to know the odds, carefully choose your hands, and be willing to walk away when the situation isn't favorable.
Right. That's a good analogy. The book provides the example of the Baycor Western takeover in 1987. It was a complex deal structure with multiple moving parts, and the market was quite volatile at the time. This created a buying opportunity for value investors who were able to assess the situation calmly and take advantage of the market's fear and uncertainty.
So even in those turbulent market conditions, there are opportunities for those who can keep a cool head and do their homework. But the book also mentions that even specialized areas like risk arbitrage can become overcrowded and less profitable over time.
Right. As with any investment strategy, there are cycles when an area gets hot, everyone piles in, driving up prices and reducing potential returns. Then when things cool down, investors can get disillusioned and pull out, often at a loss.
Right, so it's important to be aware of those cycles and not get caught up in the hype. Now, we've talked a lot about spinoffs. The book seems to be quite fond of them as a source of value investment opportunities.
And for good reason. Spinoffs often create value for shareholders because they allow those separated businesses to focus on their core strengths and attract investors who are specifically interested in their particular industry.
Right. The book uses the example of Intertan, which was spun off from Tandy Corporation. It's a classic case of a hidden gem being masked by the complexity of a larger conglomerate.
Precisely. And remember those institutional selling pressures we discussed earlier. They can create a great buying opportunity for value investors who are willing to pick up those unwanted shares at a discount.
It's like those institutions are thrown away. Perfectly good ingredients just because they don't fit their particular recipe book. Now, the book goes into a detailed case study of Esco Electronics, another spinoff that turned out to be A successful value investment.
ESCO was a defense contractor that was spun off from Emerson Electric. It was facing some temporary challenges at the time, including contract disputes and a downturn in the defense sector. This depressed the stock price, creating an opportunity for value-minded investors.
But the underlying business was still fundamentally sound, and there were potential catalysts on the horizon that could unlock its hidden value.
Exactly. The book points out that ESCO is trading at a significant discount to its tangible book value, its net working capital, and even its private market value, based on what Emerson had paid for a similar business a few years earlier.
So it had all the hallmarks of a mispriced opportunity, ripe for exploitation by a savvy value investor.
And that's the beauty of value investing. It's not about finding perfect companies. It's about identifying businesses that are trading for significantly less than they're worth, understanding why they're undervalued, and having the patience to wait for that value to be recognized by the market.
We've talked about various valuation metrics, from liquidation value to net working capital. But the book stresses that value investing isn't just about crunching numbers.
Absolutely. It's about understanding the nuances of a business, going beyond those accounting figures to grasp its true economic reality. The book uses the example of book value, which can be a misleading metric.
How so? Isn't book value a good indicator of a company's assets?
It can be, but book value is based on historical accounting and might not reflect the current market value of a company's assets. Think about a company that owns a lot of real estate. The book value might reflect the historical cost of those properties, but their current market value could be significantly higher.
So just because a company has a lot of assets on its books doesn't mean those assets are actually worth what they say they are.
Right. And then there are intangible assets like brand value, intellectual property, or loyal customer base, which are often understated or completely absent on the balance sheet.
It's like trying to value a Picasso based solely on the cost of the paint and canvas. You're missing the real essence of the artwork.
A perfect analogy. Okay, so we've explored various ways to identify potential value investments, but once we've found them, how do we manage those investments effectively?
That's a great question. The book talks about portfolio management and trading strategies, which are essential for realizing the full potential of value investing.
Absolutely. Even the best value investments can go wrong if they're not managed properly. One crucial consideration is liquidity, the ability to buy or sell an investment quickly without significantly affecting its price.
So a highly liquid investment is like cash. You can easily move in and out of it without causing a major disruption in the market.
Exactly. But there's a trade-off between liquidity and return. More liquid investments tend to offer lower returns because they're perceived as being less risky.
Because investors are willing to accept lower returns in exchange for the peace of mind of knowing they can easily exit their position if needed.
Precisely. And the book highlights the danger of illusory liquidity, especially during market panics. An investment that seemed very liquid during good times might suddenly become illiquid when everyone's trying to sell at the same time.
It's like trying to get out of a crowded theater when someone yells, "Fire!" Everyone rushes for the exits and it becomes a chaotic scramble.
Exactly. So how do we manage liquidity effectively in our portfolios? The book suggests maintaining a liquidity cycle where cash is constantly flowing in and out as investments are bought and sold.
So it's not just about buying and holding forever. It's about actively managing the portfolio, taking profits when appropriate, and redeploying that capital into new opportunities.
That's the idea. This liquidity cycle helps to reduce opportunity costs and forces us to reevaluate our holdings periodically, ensuring that our capital is allocated to the most promising investments at any given time.
It's like pruning a garden. You're getting rid of the dead wood and making room for new growth.
And speaking of managing risk, the book also discusses the concept of hedging, which is basically using various strategies to offset potential losses in the portfolio.
So it's like having insurance on your investments.
Precisely. One common hedging strategy is short selling, where you borrow shares of a stock and sell them, hoping to buy them back later at a lower price.
So you're essentially betting on the stock price going down.
Exactly. And another hedging strategy is buying put options, which give you the right, but not the obligation, to sell a stock at a specified price, even if the market price falls below that level.
It's like having a safety net in case the market takes a dive.
Exactly. The book provides a real-world example of hedging against a potential decline in the Japanese stock market, illustrating how these strategies can be used to mitigate downside risk.
It sounds like hedging is a valuable tool for managing risk, especially in volatile markets.
It can be, but it's important to remember that hedging comes with its own costs and complexities. It's not a magic bullet, and it needs to be used judiciously and as part of a well-thought-out investment strategy.
Now, the book also offers some practical advice on trading. What are some key takeaways for value investors?
The most important advice is to be patient and selective. Avoid the temptation to constantly trade or chase those short-term price fluctuations. Value investing is about taking a long-term view, focusing on the fundamentals of the business, and letting your investments play out over time.
So it's not about trying to outsmart the market or time those daily swings.
Exactly. It's about sticking to your principles and not getting swayed by the emotional roller coaster of the market.
And the book emphasizes the importance of finding a trustworthy broker who prioritizes your interests over their own commissions.
Absolutely. You want a broker who acts as a true partner, someone who understands your investment philosophy, provides sound advice, and executes your trades efficiently and cost-effectively.
Someone who's more of a trusted advisor than a salesperson. Now let's shift gears and talk about those investors who might not have the time or expertise to manage their own portfolios. What are some alternative investment options for those individuals?
The book discusses mutual funds, which can be a suitable choice for those seeking professional management and diversification. But it also highlights some of the potential drawbacks of mutual funds.
Such as?
While mutual funds often struggle to outperform the market, and they can be susceptible to the same short-term pressures that we've discussed.
So it's important to choose mutual funds carefully and to understand their investment strategies, fee structures, and track records. What about other alternatives?
The book mentions discretionary stockbrokers and money managers as other options, but it emphasizes the importance of thorough due diligence.
It's all about finding someone you trust, someone who shares your investment philosophy, and someone who has a proven track record of success over various market cycles.
Exactly. And it's crucial to ask those tough questions. How have they performed in different market environments? How do they manage risk? Do they have any conflicts of interest? How do their personal investments align with their recommendations? It's about finding a true partner in your investment journey, someone who will help you navigate those inevitable market storms and achieve your financial goals.
It sounds like finding the right advisor is a crucial step for those who are looking for professional guidance.
It is. And remember, even if you're delegating some of the investment decisions, it's still important to understand the basic principles of value investing and to stay engaged in the process. Knowledge is power, especially when it comes to your financial well-being.
You know, it's striking how much emphasis the book places on the human element of investing. It's not just about crunching numbers and building spreadsheets. It's about understanding market psychology, recognizing our own biases, and having the discipline to stick to our principles even when the market is going haywire.
That's one of the most valuable lessons of value investing. It's a reminder that markets are driven by human beings with all their emotions, irrationalities, and occasional bouts of madness. The best investors are those who can combine analytical rigor with emotional intelligence and a healthy dose of skepticism.
It sounds like a fascinating and potentially rewarding journey. We've covered a lot of ground today, exploring the pitfalls to avoid, the principles to embrace, and the strategies to implement. What's the key takeaway you'd like to leave our listeners with?
I'd say the most important takeaway is that value investing is a journey, not a destination. It's a continuous process of learning, adapting, and refining your approach. It's about constantly seeking knowledge, challenging your assumptions, and staying humble in the face of the market's unpredictable nature.
This has been an incredibly insightful deep dive. We've gone from the basics of value investing to more advanced concepts, exploring those common pitfalls that trap so many investors and delving into the strategies and techniques that can lead to long-term success. But before we wrap up, I'd love to hear any final thoughts you might have. What's one key idea that you want to leave our listeners pondering?
While value investing focuses on the fundamentals of businesses, understanding financial statements, and assessing intrinsic value, it's also about understanding human psychology and recognizing the inherent irrationality of markets. The most successful value investors are those who can combine that analytical rigor with emotional discipline, patience, and a long-term perspective. It's not just about being right. It's about being right when it matters most.
That's a brilliant insight. Value investing is about mastering both the art and the science of investing. And as we've seen, it's not just for Wall Street gurus or institutional investors. It's an approach that anyone can learn and apply, regardless of their background or experience. And remember, this is just the beginning of your value investing journey.
Absolutely. There's a wealth of knowledge and resources available to help you continue your exploration.
Yeah.
And remember, the best way to learn is by doing. Start small, stay curious, and don't be afraid to make mistakes along the way.
Wise words. Thanks for joining us on this deep dive into the fascinating world of value investing. We hope you found it valuable, and we encourage you to continue your exploration of this time-tested approach to building wealth-happy investing.